Today, I'm going to show you the 3 signals that predict a bank run with terrifying accuracy. On March 8, 2023, a group of venture capitalists did something on a private WhatsApp group that should have been illegal. They didn't steal money. They didn't hack anything. They just talked. By March 9th, depositors tried to withdraw $42 billion from Silicon Valley Bank. In a single day. That is not a typo. $42 billion. And here's what no news anchor will tell you. That bank run did not start on March 9th. It started 6 days earlier. You could have seen it coming from your living room, on your phone, for free. Today, I'm going to reveal to you the 3 signals that predict a bank run with terrifying accuracy. And if you want to see the follow-up video where I expose the bank that is quietly building the exact same risk profile as Silicon Valley Bank in 2023, hit subscribe. Signal number 1, you've already ignored it today. I guarantee it. Let's dive in. The real problem why most people stay blind. Before we get to the signals, we need to talk about why almost everyone, including people with finance degrees, fails to see a bank run coming. It's not because they're stupid. It's because they're looking at the wrong information. Banks do not fail the way movies show. There is no single moment where a manager stands up and says, "We're out of money." Instead, bank runs happen because of a psychological cascade. One person gets nervous, then 10, then 10,000. And here's the trap. Banks are legally allowed to hide their biggest weakness from you. I'm talking about the HTM label, held to maturity. When a bank buys a bond and labels it HTM, they do not have to report its current market value if that value has dropped. They only report what they paid for it. That's like you buying a car for $50,000, watching it become worth $5,000, and telling your insurance company it's still worth $50,000. Every failed bank in the last 40 years had a growing gap between their book value and their real value. And you, the depositor, are the last to know. But there are 3 cracks in the wall that always show up first. Let me show you. Signal number 1. The social media smoke alarm. Signal number 1 is the one you've already touched today. Your phone. Bank runs in 2025 did not start in the bank lobbies. They started in private group chats, then moved to Twitter, Reddit, and TikTok. Here's what I want you to do right now. Open a new tab, seriously, pause this video if you need to, and go to Twitter. Search for your bank's name plus the word risk or concerned. Look at the date stamps. Are people asking nervous questions? But don't just look for panic. Look for patterned language. In the 3 days before SVB collapsed, these phrases appeared 400% more than normal. Should I move my money? Anyone else worried about bank name, unrealized losses? This is the big one, liquidity coverage. Here's the psychological trigger. When you see 5 strangers asking the same nervous question, your brain does something called social proof cascade. You stop trusting the bank and start trusting the crowd. And here's the actionable part. Set up a Google alert for your bank's name plus the word unrealized losses. If that alert fires more than twice in a week, you are in the danger window. Not next month, now, but social media is just the symptom. Signal number 2 is the actual disease. Signal number 2. The bond market's secret language. This next part sounds like it belongs in a PhD economics class. I promise you, a 14-year-old could understand it. Stay with me for 90 seconds. Banks make money a simple way. They borrow money short-term, from your savings account, and lend money long-term, as mortgages and business loans. The profit is the difference. But when the US Treasury yield curve inverts, meaning short-term interest rates become higher than long-term rates, that profit machine breaks. The yield curve inverted in July 2022. Silicon Valley Bank collapsed 8 months later. Every single major bank failure since 1980, and I mean everyone, was preceded by a yield curve inversion within 6 to 18 months. But here's what the news won't tell you. The inversion alone doesn't kill banks. What kills them is duration mismatch. That's a fancy way of saying, they bought long-term bonds when rates were low, and when rates went up, those bonds became worthless. You can check your bank's duration gap in their quarterly financial statements. Look for a number called effective duration gap. If it's above 3.5 years and the yield curve is inverted, you're looking at a bank that is 1 bad week away from collapse. Let me give you the visual test. Go to the FDIC's website. I'll put the link in the description, and look up your bank's unrealized loss on securities divided by total equity. If that number is over 50%, that bank is in critical condition. Over 100%? That bank is already dead. They just haven't told you. But even this is not the final signal. The third signal is the one that predicts the exact day. Signal number 3. The teller's empty chair. Behavioral cue. Signal number 3 is the one that requires no financial literacy whatsoever. It just requires your eyes. Go to your bank's parking lot on a Tuesday at 10:30 a.m. Not Monday, not Friday, Tuesday morning. Count how many cars are there. Now ask yourself 3 questions. 1. Are there more cars than usual? 2. Are people sitting in their cars on their phones without going inside? They're checking balances online before withdrawing. 3. Is the drive-through line wrapped around the building, but the lobby looks empty? Here's what those mean. When a bank run is 48 hours away, the lobby empties out and the drive-through fills up. Sounds backwards, right? Here's the psychology. People who are nervous want a quick exit. They don't want to wait in line next to other nervous people. The drive-through feels faster and more private, but the real tell is the manager's car. If you see a bank manager carrying boxes to their personal car during business hours, not lunch, not a meeting, that manager knows something you don't. I am not telling you to stalk anyone. I'm telling you, human behavior leaks before balance sheets do. In the week before Washington Mutual failed in 2008, branch managers started requesting unusual cash shipments double their normal amount. The reason? They were trying to build a buffer to stop panic. But the armored truck drivers noticed. Then the drivers told their spouses. Then those spouses told their friends. And by Friday, the line was around the block. You can watch this happen in real time on Reddit's r/banking subreddit. Search unusual activity or cash delay. When those posts go from 0 to 10 per day, start paying attention. What to actually do, actionable script. Now for the part that most finance YouTubers are too scared to say. What you should actually do if you see these signals. First, do not panic, withdraw everything. That's how you turn a rumor into a collapse. If everyone followed this video's advice and ran to their bank tomorrow, I would have caused a bank run. And I don't want that on my conscience. Instead, do this 3-step safety check. Step 1, the 30-day test. Take whatever money you need for the next 30 days, rent, groceries, medications, and move only that amount to a second bank. Not a credit union, we'll get to that, a second bank. If your primary bank fails, you have 30 days of runway. Step 2, the FDIC limit game. You are insured for $250,000 per depositor, per bank, per ownership category. If you have more than that in any single bank, open a second account at a completely different bank tomorrow. Not a different branch, a different bank entirely. I use 3 banks personally. That gives me $750,000 of FDIC coverage. Step 3, the credit union myth. Credit unions are not safer. They have a different insurer, NCUA, with the same $250,000 limit. But credit unions have a hidden vulnerability. They are less regulated on liquidity. In a fast run, a credit union can freeze withdrawals for up to 7 days without warning. Banks cannot. For cash you need next week, use a bank. For cash you need next year, a credit union is fine. And finally, keep $500 in cash in your home. Not in a safe deposit box. Those get locked during a run. In your home, in a place you can reach at 2 a.m., that $500 is your bridge. It covers gas, food, and medicine for a long weekend while the system stabilizes. I have done this for 7 years. It has never cost me a penny, but it has saved me 3 separate times from losing access to money during regional banking scares. The counter-argument, why most of you won't do this? I'm going to pause here because I know what some of you are thinking. You're thinking, this won't happen to my bank. My bank is too big, too old, too connected. Silicon Valley Bank was 40 years old. Signature Bank was 24 years old. First Republic was 38 years old and had a waiting list to become a customer. Size does not protect you. In fact, size makes the run faster because large depositors coordinate. Here's the uncomfortable truth. Bank runs are now faster than ever. In 1933, a bank run took weeks. In 2008, it took days. In 2023, SVB went from healthy to seized by regulators in 48 hours. The mechanism that made runs slower, human tellers, paper checks, physical lines, is gone. Now, you can start a bank run from your phone while sitting on your couch. And 40% of bank deposits in the US are above the FDIC insurance limit. That means 40% of depositors have a rational reason to run first. So the question isn't, will there be another bank run? The question is, will you see it 6 days early, or will you see it on the news? You have the 3 signals now. 1. Social media sentiment spike. Check it weekly. 2. Yield curve inversion with high duration gap. Check it quarterly. 3. Behavioral cues at your local branch. Check it monthly. That's 6 hours of work per year. 6 hours to protect yourself from a lifetime of standing in line next to people who didn't watch this video. If you made it to this part of the video, you are in the top 3% of viewers who actually finish what they start. That means you're my kind of person. Here's what I want you to do right now. First, go check your bank's unrealized loss number using the FDIC Bank Find tool. Link in description. Come back to the comments and post the name of your bank and the percentage you found. If you don't know how to find it, ask. I read every comment for the first 48 hours. Second, screenshot this video's thumbnail right now, pause it if you need to, and send it to one person who banks at the same institution as you. Just send the screenshot, no text. Let them ask you what it means. That's how you start the conversation without causing panic. Third, subscribe if you want the follow-up video where I expose the one bank that is quietly building the exact same risk profile as Silicon Valley Bank in 2023. I've already done the research. I am a chartered banker. Don't trust the bank, trust the signals. I'll see you in the next video.